Look, most traders lose money because they keep choosing the wrong order blocks and they don't even know why. So let's strip this back for a second, because most people are just drawing pointless boxes on their charts without ever even asking what they actually mean. So what is an order block actually meant to do? An order block, as I'll show now, is an area where orders are blocked. It's essentially where retail traders have been tricked into the market, thinking that they're going to push the market, in this case, up, when really the institutions, if that's really who is behind the big moves, are trying to push the market down. They are stuck in the wrong direction and they are waiting for price to potentially come back and get them out at break even at best. The whole purpose of an order block is it's trapping traders in the wrong direction and then using their liquidity when they get stopped out to fuel the market to the next destination. And that's why order blocks are often linked to imbalance fills or FVGs, because there is a massive lack of liquidity. The liquidity is within the order block and just beyond the order block, which is essentially an exchange of power. And if we're trading them correctly and we can drop down to a lower time frame for a precise entry, and we follow a set criteria of what generates a perfect order block, then that can give us a killer entry. And this example right now is a live trade that is ongoing, which I'm going to show my live broker feed shortly, just to explain when you take a good order block, it can work out extremely well. Now, whether or not all my theories around the liquidity side of things and how and why the order blocks are formed, whether or not it's all 100% accurate, it doesn't really matter to me because it fits the narrative and it works. So if you follow the same format as I do, you're going to be able to trade order blocks as well as I do. So now let's look at the common misconceptions about order blocks, because for a lot of people, this is where their consistency pretty much dies. Now, the first mistake is always picking the most recent candle in the opposite direction. Even though there might be a few confluences in its favor, does not make it necessarily an order block. It's just the extreme of that little bit of the move, but it is not the decision maker. So let's play this out just a little bit and we'll move on to the second mistake that people are going to be making. Now, as we can see, that move would not have played out. This was the order block in question. That would not have worked. Yet at the same time, the second mistake which I see people making is that they're not considering the higher time frame context. Now, just for your reference, this is the 1 hour time frame at a random point in time. Now, if I flick over to the daily chart, which is the time frame which pairs really well with the hourly, we are quite clearly in a downtrend on the daily, okay? There's nothing saying really that the market should be going upwards. We'd be trading in the wrong direction of the higher time frame. Try to do it less and less, because you're going to get most of your winners in the same direction as the higher time frame, and you'll also get those winners a lot faster. The third is trying to take a trade from an order block that's already been mitigated or rebalanced, and thinking just because it looks good and it's in the right kind of area of a chart, say the halfway point on a leg which has been very bullish or bearish, once it's already been rebalanced or mitigated, it's done. Okay, don't take a trade from it. We're going to carry this across and see what's happened. A lot of people would look at this area and say, okay, pretty decent. No, happens all the time. If it's being rebalanced, even with the next candle, don't take it. It's not a valid order block. It's already been done. Another one is just mistaking an opposite colored candle with a little bit of imbalance and maybe a sweep as a valid order block, when actually you need confidence with additional confluences. It's all about decision making while stacking your confluences. And if you don't have enough of your key confluences stacked, it's not going to be a valid order block. So let's play this out a little bit. We don't break the low, we get mitigated straight in. It ends up being the right area, but your trade has failed. And even if you do find a good order block, which tends to fit all your criteria, a main confluencing factor is whether or not you've got a high enough risk reward ratio. With this example, it's only a 1 to 2. I require a 1 to 4 for consistent profits because the win rate is 30%. So if I'm not going to be getting a 1 to 4, I'm not going to be trading a profitable strategy over the long term. Therefore, this is one which would have to be a miss. But while we're on this one, the biggest issue that I see traders taking is that they are taking variable entries on each of their order blocks. One day, it's like they're trading off the zero, okay? And by the zero, I mean the retracement. I use this. I use a simple marker, and on the M15 specifically, and only on the M15 on Euro USD, do I use the 0.25, which is that nearest quarter, as my entry point. Okay, that's because it's the median impact zone. Now, sometimes people will take it off the 0.25, but they'll do that on the H4 or they'll do it on the daily. Other times they'll be taking trades off the halfway point. Other times they'll be refining down to a lower time frame to try and get their entry. The main thing is that consistency matters. You don't want to be taking guesses while you're in the live market. You need consistency. Leave all the guesswork at home, get all the data that you need, and start trading one method. Because if you can't define what you're entering on, that's not trading. That's just playing roulette. And there's casinos waiting to take your money. So you might as well just go there. And while we're at it, no, price doesn't have to refill imbalances. It doesn't have to be taken. You don't have to be taking trades off of fair value gaps. You don't need to be looking for breaker blocks as well as extreme order blocks. You don't need to be looking at order flip zones, because at the end of the day, you're just going to have too much crap on your chart. You need to be trading one method. Fibonacci retracements, fair value gaps, load of rubbish. Trade order blocks. Because at the end of the day, what we're looking for is consistency, not mess on the charts. I'm going to flip over to a live trade right now, which doesn't show all this shit on the chart. It is just very clean and very smart. This is my live trade right now, and I'll show you the broker feed as well in a moment. But M15 to M15, okay? It's using the 1 minute as a time frame to enter on, and I'm taking profit at the next M15 if it reaches there. It's a 1 to 15 risk reward ratio, and I'm risking 100 quid on the trade. So I should be making £1,500 if it lands. Awesome. Very clean chart, very clean visuals, and only the valid order blocks marked out. The higher time frame in this scenario is the 15-minute time frame. That's why they're marked up on my charts. The 1 minute is where I entered, and I will show you in a moment the broker feed, but I entered about here, stop loss literally above the sweep. I took the sweep entry, and the target is literally down here. Pretty simple. So I don't really care about the fluctuations. I'll just let it run. And if it hits, awesome. If it doesn't hit, whatever. I'll just wait for the next one. So here's the live chart showing the entry. Okay, there's the 15. Here's the M1. I'm going to cover up my balances and stuff because I don't want that on the internet. But there's the entry, pretty much where I said that it was. I was a tiny bit late in, so I didn't get the entry that I wanted. The risk is £105. And the target, if it comes in, 1,516 minus my commissions, which will be about 1,500. So really simple, really easy. These come about multiple times a week. The strategy averages about 20R a week on Euro USD alone, and that's using the 15-minute and 4-hour. That's not even scalping like this. So anyway, on to the next section. The 5 key traits as to what makes a good solid order block. First of all, the trade needs to be aligned with the higher time frame. Now, as I mentioned, I took the trade off of the 1 minute, which means the higher time frame is the 15-minute. They're just two time frames which work extremely well together. Another is the 5-minute and the hourly. Beyond that, there is the hourly and the daily, and there is the 4-hour and the weekly. They just work really well together. This is the higher time frame order block. There is the higher time frame order block target. Price I'm expecting is going to bounce between the two and then make its decision as to which direction it's going to go. Now, the higher time frame trend, I'm just going to show, we've pushed up off of here, which had rejected months ago. We've broken down, we've broken the lows here, we've bounced off, we've come up, and it looks as though we have rejected off of this. We've got the sweep, and we're probably going to go down. Okay, so the higher time frame is saying that the market is going down. The 1 minute, which I've taken the trade off, is also in the direction of the 15-minute, which is the higher time frame. So my trade was like so, in the direction of the higher time frame. Always try to place your trades in the direction of the higher time frame. in comparison to the entry time frame. And the reason for that is most of your winners are going to come from that, and most of your winners are going to come very fast in comparison. Sure, this was a slow start to the trade. After half an hour or so, we got a nice push in the direction that we wanted the trade to go. And the target, we're halfway there. The second key confluence for me is that the entry needs to get a sweep, okay? Now, you don't have to do this. This is just one for me. I prefer it because it gives me that stronger confluence. But I like a sweep and a close back in the range with an opposite candle, which is exactly what we got from this red candle. Now, if you remember going back to my C-Trader chart, it literally showed the sweep of the 15-minute area and the entry very shortly after, as soon as I could get my figures typed in. So as soon as I was in, perfect. We got the sweep, we got the close, happy days. Now that sweep can just be of a previous high. It doesn't have to be of a 15 zone. It could be of a series of M1s alongside it. It just needs to be a sweep. It needs to take the liquidity to feed the strength of the move down and give you that kind of visual appeal that we are moving in the direction that we want it to go. Trait number 3 is that there needs to be imbalance leading into it. Now, to explain that, this is the order block which I was targeting, okay? This was the M15, and the imbalance is coming away from the order block. But because we're taking the trade coming back into it, the imbalance is essentially leading in. So as long as you've got imbalance and you've got a sweep of sorts or a mitigation, okay, a mitigation of a previous order block in this case, and the sweep and the nice strong move breaking the immediate levels and that level as well, I've got a good confluence stack behind me. The fourth trait is that it needs to be unmitigated or not balanced. So with some order blocks, like order blocks, you will see that there have been rebalances immediately by the next candle. So here was an example a little bit earlier on, I think, where it's just not the right type of candle to consider an order block. It makes sense that there's a recoil just here, but we got a rebalance straight away from the next candle. We even got a reaction the second time we got to it. But the fact of the matter is that this was not the decision maker, because when price actually decided to come back to it, it's decided to run the liquidity above it into the order block and give me the trade that I wanted. And trait number 5 is obviously the risk reward ratio that I'd mentioned previously. I want a minimum actually of 1 to 3.75. That is the bare minimum. 1 to 4 is the easiest that I can mark on the chart. But this, 1 to 15, not going to argue with trying to take a trade, especially with a 30% win rate. Of course, there's going to be lots of losing streaks, but that's just trading for you. This gives off a very, very profitable strategy at the end of the month, every month. And with my criteria, if it ticks all the boxes, that's when I'll get serious and I'll get into those positions. And I'll take them all day, all night, every night. Doesn't matter, any time frame, any currency pair. I'm happy to take the trades because I've got all the key confluences that I need. Now, most traders know what an order block is, but the difference, I know how to spot one before it works. Let me show you. Now, these two order blocks look really similar, very much identical. Now, if I actually pull it back, they even have similar prevailing trends. They both provide 10R, one gets stopped out and one works. Why is that? Let's go into detail. First one. This one looks textbook, doesn't it? It's a pretty strong move, nice prevailing trend. It's halfway down. It's got probably the last sort of down candle or last congestion area before the big push up. Looks fairly decent. However, one key issue with this order block is that it was immediately rebalanced and mitigated before we took off. So even though it's got a lot of the confluences in its favor, probably the key confluence to order blocks is you don't want it to be rebalanced, you don't want it to be mitigated. There needs to be a clear bit of imbalance before your entry. Now, if we look at the second trade by comparison, it's again pretty much the same to an extent. It didn't have that very clear run in like the previous candle, but the previous trend was pushing up. We got a nice imbalance. We also got the sweep similar to the last one. Price had pushed up away from here. It's slowly come down to it. We ended up getting quite an aggressive entry towards it, but we've got the imbalance, okay? We've got the imbalance, which means that we get an entry. If you go straight off the zero, just on the 1 hour time frame, got the entry. If we look at the highs on here, for reference is 718. The low of this is 717, so 0.1 pips, enough to get in for a lot of people, and off you go to the races. So really similar side-by-side example. One had imbalance, one had been rebalanced. It's quite easy to see which one tends to work the most. Now this side-by-side is fairly interesting because they're both within the same sort of 10 minutes of happening. This had happened just the previous Friday. One was taken by a trader in FTR and he ignored the first one. So the first one, again, risk reward ratio. Okay, it's not fitting the core criteria of what we need for a profitable strategy. So this one, despite it making sense that we were getting boss and it was a pullback, it had the sweep, it was an opposite candle, it had imbalance, but the immediate target was not far enough. Okay, it was only 1.74. The second trade, however, still adhering to the higher time frame. We had the nice sweep, it was an opposite candle, we had a good imbalance, we were feeding up. Yes, it went a little bit further, but following the higher time frame trend, which was pushing up, it was a 6.65% trade. Fantastic. The fact is that the target fit the minimum trade criteria, the minimum risk reward ratio, and off it went to target. And it ended up going on and on. And this guy took, I think, about 20R on his trade. I'll post that snippet in here just for reference. And finally, on that part, I will say it's not about being perfect. It's just about being consistent. It's what you filter in and what you filter out, which makes the big difference in the long term. The second that you trade something just because it looks right, but it doesn't quite fit your criteria, is the moment you give your edge away. And your edge at the end of the day is what you have as an advantage over the other traders in the market. Trading is a zero, maybe even a negative sum game. So you want to make sure that you've got an edge. Do not let it erode. So let's go back through the checklist. 1. Does it fit the higher time frame narrative? It's rejected the M15. It's going down towards another M15. Check. 2. Did the candle sweep something clean? Yeah, it swept the M15. We got it. Check. 3. Was there strong imbalance leading in? Yeah, there was. Check. 4. Had it been mitigated? No. There was no, rebalance straight away. It hadn't been mitigated prior. Perfect. Check. 5. Does it have a strong enough risk reward ratio? Well, if I'd have entered off the 0.25, no. But I did see the opportunity for the M1. So ended up getting 15% if it comes through. Check. The fact of the matter is this: you only need 1 or 2 clean setups per week to be able to grow your account quite rapidly as well. And this is how I stay consistent. So if you're trading order blocks and you're not getting results, it's probably not your discipline, but it's most likely going to be your filters. What confluences are you choosing? What confluences are you not choosing? Are you paying attention to the wider market, the wider time frame, or not? This is the type of stuff which we break down in FTR trading with full back testing, data, and real-time support. So if you want to apply, the link is in the description for you. And if you want to do this solo, I've been there, and this framework helped me remove the doubt behind my trading, because once you've got the rules, the rest is just execution. Oh, and by the way, just before I log off, just TP'd. Price is reversing sharply, exactly where I said it would. So this shit works. Join me at FTR, links below. Now that you've nailed order blocks, that's great, but without understanding structure, they're almost useless. So watch this next video and master the two together.